Okay, so welcome everybody. Paul Langham from Exact Trading. I'm recording. It's rather like the BBC. This has just been through my initial chat to those people that were on early, but now we're recording live. So I'm very, very pleased to launch this webinar this evening. It's going to be about PitView, the software which analyzes bid-ask spread. And I'm very, very pleased to introduce shortly Stephen Cutler from PitView, who is the CEO, the founder and inventor of the application. And as I've said, just for the background for people who are going to be listening to this webinar later, because I have had a lot of people who have said that they're actually on a different time zone. Tried to get most people involved, obviously with the three time zones, UK, Europe and the US, certainly Eastern. I've been looking at PitView for a couple of years. As I said, I've been actually following or interested in bid-ask spread from 2004 when I was actually working temporarily for a small trading house in London. And that's when some of the initial software came out onto the market about what was actually happening inside the bid-ask spread. And so what we're going to do is just very quickly, I'm just going to very quickly go on to the first slide here. Hopefully everybody can see that. So the agenda. So I'm just going to introduce PitView, which is what I'm doing now. Give you a high-level reminder about actually what PitView is, and then bring Stephen on. He's going to describe how PitView came about, explain some of its history, do some relatively in-depth analysis of actually how PitView can be used to gain an edge in the markets, and then we're going to have a discussion based on what is described. At the same time, but after that, there will be some further questions which were sent in by existing clients, and then Stephen will also give us an overview of how he plans to improve the product, what's going on in the life of the product currently, what they're doing to the website, to the actual product, what's going to be moved, what's going to be introduced. So it's going to be interesting from point of view for how we are positioning ourselves with the tool. Just so that everybody knows, that is the hopefully everybody can see that it's www.pitview.com. I just took the snapshot of the website this evening. So it's PitView for Forex analytics and MT4 trading tools. Stephen will obviously explain that obviously in more depth, but that's where it is. Just make a note of that if you want to have a look later on in proceedings. And just yet again, just to keep it slightly technical before we go, just remember that PitView is measuring what's happening inside the bid-ask spread. And also remember, retail, we're buying at the ask, banks are selling to them at the ask. Retail sells at the bid, banks buy from them at the bid. So it's the question of what banks are always buying at a lower price, selling to the retail at a higher price. That's where they make their spread. And the concept is that banks who buy, aggressively inside the bid, are seen as being very aggressive. Reason why they might do that is they could have inside knowledge about future price jumps, or they might want to build a position in anticipation of further rise in prices sometime in the future. Or it could be simply front running, which, as we know, is if you have a big order comes into the bank, they want to get into their position very, very quickly and before that order comes into the market, which raises the market. And that is a process which is actually still not illegal in FX. That's perfectly acceptable to do that. It's called front running, and that they might want to hit the bid very, very heavily just to get their position as much as they can on before they action the client order, which they know is going to jump the price by say 5 to 10 pips, and then they will suddenly move out of the market and just sell. Okay, so now what I'm going to try and do is go back to the upside here. I'm going to try and bring on Stephen. Hopefully this will work. Hopefully we're going to do that. Just 1 second. We're going to make... Okay, Stephen Cutler says he's got control of my shared application. I also want to give him control of the microphone, hopefully. Okay, just 1 second, guys. 1 second, just as typically these things happen, just having a little bit of trouble getting the passing control to Stephen. Try again. Hopefully you can hear. Unfortunately, I'm not getting any response from him at the moment. Okay, so just getting a message from Stephen saying he needs some help taking over. Okay, just 1 second. I'll just try and do it another way, actually. Just 1 second, guys. Okay, could be Stephen should be able to.
Paul, can you hear me? Paul, can you hear me?
Yeah, we can hear you, Stephen. No problem. We can hear you. Yeah.
Okay, do you see my screen?
I can't see your screen yet. No. Let me just.
How do I do that?
Okay, you have to start the video, I guess. 1 second. Okay, it's going to switch to you now.
Okay.
It's coming over to you. Sorry about this, guys. I think we're nearly there. And then what you will have to do is you will have to get your slides up and then just click the share button.
And where would the share button be?
If you just move your cursor to the top of the toolbar there, you'll see there's a little drop down and it says share, and you can select the application which you want to share. Okay, I see something happening. You're now sharing Skype, so you can just change. That's it. You can just actually switch to your slides there. Can everybody just type in the box if you can hear Stephen and everything?
Hi, everyone. Can you hear me?
Yeah, I think we're fine, actually. I think, yeah, we're all okay. We're all okay. Okay, sorry for that, guys. Sorry for that, guys. I will just remain silent now, and then we'll just get going with PitView. So welcome to Stephen. Thank you very much, Stephen. Sorry about the technical difficulty there, guys, but I think we're there. And thank you very much. So take it away, Stephen.
Okay. Well, thank you for inviting me, Paul. And this was kind of last minute. So I wanted to walk you through a slide presentation that we prepared for introducing people to the concept of PitView. And I think it's really important because it will show you all the theory behind it and help answer a bunch of questions that you might have. So to begin with, my name's Stephen Cutler. I'm the founder and CEO of PitView. And today I want to show you basically what we've come up with as, because we're trying to teach more than PitView itself, but our goal is to make people into better traders if they're already successful, or having turned the curve if they're not. And the value of PitView is actually to supplement whatever trading system or trading methodology you already have. So it's totally appropriate with what Paul's teaching you. It's appropriate with a lot of other different approaches to trading, whether they be longer term position trading, swing trading, scalping. It seems to work across the board. So let's get started. I wanted to say I'll be answering any questions at the end. And so let's get going. I led the team that started with the whole concept of PitView, and I wanted to give you a little color of where we got to where we are today. It'll help put things into perspective. And so the reason we're all trading is because it can give us freedom. And that's the main thing that we're trying to get. It can be transforming in our lifestyle. One of the things that I want to get into later, and I talked to Paul about it, is we really need to examine the reason why we're trading, whether we're trading because we like to trade, or whether we're trading because we want to approach this as a business and we want to use it as a vehicle to improve performance and actually make it into a business. So a lot of us, and I'm included in this, I've been there before. You know, we go through, and it's natural, we go through a series of ups and downs in this process. When it comes down to being successful at trading, it's no different than being successful in any other business or endeavor or profession, whether it's teaching or medicine or law. It's something that requires practice and skill and understanding of what you're doing. And the best way to learn that is from people like Paul, who can be mentors for you. You've all seen this before. Typical risk disclaimer. And so, that's behind us. Here's our goal. Here's what we're trying to do at PitView. We're trying to help two types of people. Those that aren't profitable yet, and those who are already profitable, and we want to make them more profitable. So what I'm hoping that you'll understand today is, and when you get through this, you're going to say, well, this is really simple. And why wasn't it obvious before? But all or a lot of profound things in life are really simple. And so you'll see as we go through. So here's the 3 secrets. And to trading profitably, Forex, you got to watch the banks. And the next thing you have to do is follow the banks. And the third thing you have to do is manage your money and risk. This is a picture of me. And I'll tell you the story of how we got started. It all started with a key question that I had a long, long time ago. And that key question was, I had been trading the financial market since the 80s. And in the early 2000s, a partner and I, we were trading IPOs. And Level 2 had just come out a couple of years before. That's where it showed you what all the different market makers were doing. And it was transformative for my partner. He wouldn't put on a trade without seeing what the market makers were doing. So it was very, very interesting. And the question I asked myself is, wouldn't it be nice to follow what the market makers are doing? These are guys that drive the markets, and we wanted to be able to see them in real time. The only, this is cute, I couldn't resist that. We found that that there was a huge gap in what was being presented to the people. The information in this Level 2 form was nothing more than a quote window that came up. Information came in, it was displayed, new information came in to replace it, the old information was thrown away. No one was doing anything with it. There was no way of really systematically following the market makers. And it still exists that way today. I mean, this is the way it used to be done. Guys were on the floor, and they were the only ones that were really following the market makers. And the reason they were down there is because they could see what the guys were doing. I've talked to a lot of people who used to be ex-floor traders, and they said, of course, it wasn't them that would fit into this category, but they would tell me that most of the guys on the floor didn't know how to make any money trading. But what they did know was who the big traders were, the big brokers, and they knew how to see if they were buying or see if they were selling. And that's what gave the guy in the pit the ability, the edge, because he could tell if someone was trying to offload a large position, and he knew that if that was the case, once that position was off, the market could go right back. So that was the perspective from the floor. This is what they gave you in Nasdaq, Level 4. I don't know if you can see my mouse. It would identify, here's Cisco, and it would identify all the different market makers. These here are market centers rather than market makers. But this was the kind of view that they had. If you wanted to follow a bunch of stocks simultaneously, you needed a lot of real estate, many monitors. Here's an example of a guy, and there's several different Level 2 screens up. So what happened was, what we did was, we found that the way it used to be, if your eyes weren't nailed to the screen, you'd lose track of what the market makers are doing. So we went and built software to automatically follow the banks for you. And we hired a programmer and built a software prototype, and it was for stocks. We were initially able to follow 50 stocks and about 200 market makers for each stock. And then eventually we got up to 1,000 different stocks that we could follow at one time. So our platform evolved from stocks into Forex. We found in this process that what we were doing was totally unique. We wound up getting patents for it. And, so it's really, I'm sure you could begin to understand conceptually why it's so important uh, to be able to find out what the market makers, or in the case of Forex, the liquidity providers are doing. So it took us about 12 years to develop this platform, and it's pretty interesting. So again, this is the secret um, of what we're trying to do. So what happened was, although we got our patent on our analytics, let me see if I can get back to there. Every other tool that's out there that looks at analytics is focused on either price or volume. It's focused on what's already happened. So they're really looking at the markets backwards in time. By contrast, our analytics are based on the bid and ask. And why? Why is this important? It's important because the Forex market is an auction. And in every auction, the ones you see, Sotheby's and everything, before price changes, the bids and offers, bids and asks always change first. And so what we've done is we created analytics that are based on behavior. They're not based on price. And that's why you'll see later why our analytics don't track price. They're not designed to track price. What they are designed to do is track the behavior of the banks. And when you're able to track the behavior of the banks, you have a price leading change that can help you get an edge. And this is the edge that will give you a look ahead about what's to happen. And so you'll begin to see that we're looking at things differently. That's the edge that PitView brings. And so what we're going to try to do is teach you the obvious. So this first secret's obvious. The big banks control the Forex markets. And I know this is back to the basics. They represent at least 90% of all Forex trading. The remaining 10% is done by everyone else. So unless you know what the forces are that are driving the market, the banks, you have little chance of trading successfully on a repetitive basis. So this is something that's only available in PitView. And the next obvious thing is, now that you've watched them, you see what they're doing, you have to take the initiative and do something. You have to follow them. You have to take action. And so I know a lot of people could say, well, I'm already trading profitably and I'm not following. But we've proven to ourselves that all long-term successful trading has to follow, the rule of following what the banks are doing, the guys that move the market. Now, there's a big difference between following the banks accidentally and following them on purpose. And your trading's can only improve when you're following them on purpose. And that's what PitView can help you do. The third secret is this is really, and I call it a secret, that really separates the traders who make money over the long term from those who lose. Unfortunately, and I've talked to Paul about this and every other successful trader, that developing this skill, the ability to manage your money and your risk, is the last thing that a trader learns before they can turn the corner into long-term profitability. It's my belief, and everyone that I talk to who's already taken this journey, that learning to manage your money and your risk isn't the last thing that you should learn. It's the first thing, because without the proper tools to objectively and consistently, and that's the word, objectively and consistently manage your risk, your results are going to be all over the place. And just think about it, for the beginning trader, proper money management and risk, it will allow you to stay in the game long enough to master your trading strategy. So, because your losses are going to be controlled. When you lose money, the next trade, you'll be risking less capital, and you'll never get to zero. You know, people blow up mostly because of, at the beginning, because they're not managing their money properly. So anyway, the thing that I want to emphasize, and you'll see, is that PitView really works for all kinds of people. It's worked for people who are scalping. It works for people who are trading off of 4-hour bars, and it works for people all in between. So again, the 3 secrets: the banks drive the markets. You got to watch the banks, you got to follow the banks, and you got to manage your money and risk. There are a couple myths that I want to dispel, and actually what I want to do is just go back here and touch on these things again. So until now, before PitView, you couldn't know what you were doing. You couldn't know if you were following the banks or not. And I'm going to show you some live examples of what that translates into. So this is a myth that I touched on before. I want to just take a couple minutes. And this one is, you consistently make money without knowing what the banks are doing. I don't agree with that, because they control the markets, and they're the ones that make the markets move. So that doesn't work. So here's an example of a little window that we have. It's what we call total view over here, and this is what we call pair view. We've essentially boiled down the analytics to these 2 windows. This is all that you need to be successful. The total view window shows you what 94% of the Forex market is doing for any time frame you want between 1 minute and 24 hours. And pair view is our tool for scalping the markets. We've touched on this before, and there's no sense repeating it. The thing that's really, again, critical to me is this number 3, the importance of risk and money management. It can't be over emphasized on it. And one of the examples that I wanted to point out, and actually it's how important it is to eliminate risk and eliminate losers. And so anyway, what we want to talk about is in what you're going to have to do, and the confusion that people are having with PitView is you're not thinking like a bank. And when you look at the chart, you have to put yourself into the position of a bank and start asking yourself questions like, what would I do if I were a bank? You know, what part of the trading cycle am I in? Is this a place where banks would be initiating a position or liquidating it? and you'll see why that's important, and you'll start to learn how to change the way you look at things. This is total view. I touched on that before. And on the left, it shows you what the 8 major currency groups in the world are doing. And for each group, what we want to do is look at the currency group that's the strongest and try to to look at the pairs that group is strongest against. So in this particular instance, British pound is strongest against the euro, next strongest against the Aussie, and you can see at the end, basically, it's actually weak against Kiwi. And so what we've done, these little asterisks represent inverted pairs. There is no pound euro, there's only a euro pound. When we've inverted the pairs to give you to compare apples to apples. And so that's the little indication of inverted pairs, the asterisk. So just realize what you're looking at now. This is 94% of the Forex market, and it's based on bank behavior. So in this little window, you can see all the bid ask and balances over any time frame. And again, this has nothing to do with price. Now, here's a concept that we're talking about, and this was something that a friend of Paul and mine, he works with us very closely, Tim Blanchard, he came up with this idea and refined the idea, and it's part of a give and take that we have with people who are active, and it's the concept of confluence. Now, what we're looking for is to take look at different time frames, and what we're looking for is confluence, and that means over different time frames. And this one on the right set for the 1 hour view, for the 4 hour view, we're looking for things to come together. This is an example of what you see most of the time, which is they're not together. Now, of course, people want to show you, I mean, what we were looking for is, let's say, for the bigger picture, for, let's say, Canadian dollar to be the strongest group, we'd look at the same thing happening on the 1 hour, and it's not. But the point of the matter is that ultimately what we're looking for are setups. And this is an example of one of the templates that comes with PitView, and we call this PitTrader 2. And these are a couple built-in templates, and what we're trying to do is only look for trading opportunities that have two things going for them. One, they're in a position where they're above a longer term time frame. This time frame is set as a 50 period moving average. Very, very simple. And so what we're looking for are opportunities where PitView is above the zero line, which means that the banks are buying, and that the price is also above the zero line. So you can see in certain examples here, in this particular area of the chart, we'd only be looking for sell positions. We wouldn't take this trade because PitView was still above the line. This up trade we wouldn't take because it was below the line. This short we wouldn't take because PitView is above the line. And here's a first trade that we would take. nice trade up to here. How you manage the trade, that's a different story. This short trade here can be used to exit your position. We would not use it to enter a new position because the price is above the longer term moving average. Here's another position where we get a signal to go long. PitView is above. We have a nice trade coming up here. And that's the idea. You just kind of follow through, and it offers a lot of trading opportunities. We will get to that with some live examples soon. This is a trading ticket that we found and that we developed. And we developed this trading ticket for our own trading. We're all traders. And one of the things that this does is it will calculate what we call true risk automatically for you. It keeps track of your equity, and all you have to do is determine your risk that you want to put on a trade, your stop loss for the trade. Everything is done for you instantly. And we call this concept true risk because it takes into account things that people aren't normally aware of. Take into, as I said, your account balance, your commissions, your spreads, your slippage. And we've also come up with a proprietary money management formula that allows you to mix your risk as a percentage of your capital. That's the money that you put in and is most important to you, and a percentage of your trading profits. And so this trading ticket that we've created, there's nothing like it around. And then we've also recently incorporated in our trading ticket, just released it, the automatic management of your trade. You just input your stop loss, you enter your trade, and your take profits calculated for you. Then we have this advanced trade management, and you just go and put in your additional stops if you want. Some people like to put multiple stops under their entry so they scale out of a losing trade, and multiple profit targets. They scale out of a winning trade, and trailing price stops. So you can just set these things and go away. This is an example of the trade manager and some examples of the control that you have in the advanced settings for managing the trade. It's pretty cool. So anyway, here's what we covered. The crucial insight is that the banks are the forces that drive the markets. And the fastest way to exponentially grow your account is by trading in the same direction as the banks. So the secret is watch the banks, follow the banks, and manage your money. And that's basically it. So let me switch over to some live examples, show you a little bit about what's happening. Here's an example of, it just happened to be Kiwi dollar. This is a 1 hour time frame. And you can see that here, this dotted line on the bottom is the zero line for PitView. This means that everything above this is above this line, the banks are in accumulating mode. It means they're trying to buy, accumulate. They're only in the buy mode. So this is an example, again, of some trades that you'll only want to take the long trade, not the short trades. This is a trade that you get a profit on. This is a trade that you probably might be a little a break even. This trade you wouldn't necessarily take. Here's a trade that you would take a little profit in it. These are some break even trades, but here's a trade that would get you in for a really big move. You get out at this point and wait for the market to settle on itself again. So let me just bring up PitView and show you some examples. I try to look at, set it up for what we call Confluence. I showed you this before. And we're looking, what I typically like to do is look at the longer time frames as a setup for 1 hour trading. You can look at whatever time frames you want for your trading style. You just click on it and it will show you what the market maker bias is for any time frame that you want. Then if you see an opportunity, Confluence, there's none here, but your trading opportunities are typically in the upper corners. What you're looking for is the strongest group and the strongest pair, the strongest pair in that group from the perspective of that the lead currency. So in this example, it's for the last 4 hours, the dollar is stronger against Kiwi, and which means that and this shows you that it's an inverted pair. This shows you that that the dollar is in a move to it's coming down. So what we would be doing here is we know that we're below the longer term trend. We know that PitView has now just crossed the 0 line. So these guys are in a sell position. And we'd be looking for a sell signal up here to go short, because it looks like they've gone from their buying mode into their selling mode. When you find something you like, if you had another pair, well, this is not a very big imbalance, but we can just show you the versatility of it. You just double click on a pair and it immediately changes the chart for you. So these are just some other examples of opportunities. Here's well, all these trades are, again, just examples of trading opportunity. This is from from the event last week on the news, and you wouldn't have really had an opportunity to get in this trade because of gap. But once you got into the trade, you would have an opportunity to go short again here for a nice little profit, an opportunity to go short here again for a nice profit, and then PitView went above 0. Here'd be a little trade. You could take a scalping position in it, and this trade you would have gotten in here because it went above the 0 line. It pierced the longer term market, and then it just went up. So let me show you also how our trade ticket works. It's very, very interesting. Here's an example of the trade ticket. It's automatically pointed to this pair. When you change charts, the pair will point exactly to your chart. You have an ability here to adjust your lot size. You can make it automatic by your risk. This is 1% risk. You can see here's the lot size that's calculated for the 1% risk. And so you'd be risking 1% of your equity on this. That's an equity risk. You can see that if you're willing to risk more of your percentage, that this value goes up, and you can control this and put any value that you want in there. You control your charts by here. Everyone likes to trade Eurodollar. So here's an example of your position based on a 3% risk in your dollar. You could also say, well, I want to risk a fixed amount. And so what this is doing is it's calculating your lot size based upon a fixed amount of capital that you want to risk based on your stop loss. If you increase your stop loss, then you can see your lot size increases. And what we have also the ability to do is to automatically allow you to take profit targets. You can control your take profit by tying it in and set your own ratio. And the ratio can be anything that you want it to be. Here I've made a profit to loss ratio of 1. No one should be trading at a profit to loss ratio of 1. This is probably the least of your trade, 1.5. So you just click on that. They're tied together. Your take profit is 1.5 times your stop loss. You want to put the trade on. You just click, you put your trade on, and then we also give you a confirmation. So it comes back. You see if you've made a mistake, you have an opportunity to go right back in and correct it. Everything that we do is shown in a trade manager. We allow the trade manager to be compact to display whatever information is that you want to do, and then just to expand it, and you can manage everything that's important to you. It's really a very, very powerful thing. One of the things that I really like about it is, let's say you're in a different trade. You want to see what's happening on the trade. You just go click on the symbol. It changes the chart. You're pointed back right to your trade. But so that basically gives an overview, an introduction to what we're doing. And I'd like to answer some questions now. There are a couple questions that were submitted ahead of time. So let's see what question 1 was.
Stephen, sorry, I don't know if you can hear me still. Can you hear me?
Yes.
Okay.
Yes.
Well, firstly, okay, thank you very much for that explanation. I've got a few questions which I know probably the associated group will be interested in.
Sure.
Firstly, very, very interested in what you're doing because as I've always said, and I think we've always tried to, what I've always tried to suggest to people is simplicity is everything. And I quite like the way that you're just actually using the moving average as a filter, because this is one of the things that a lot of the big top asset managers do, the CTAs. They actually use the 200-day moving average normally on stocks as a filter.
Right.
So, and that actually obviously is proven to work over many years, and you can look at all the statistics from people like Dunn and Co, those type of people, Dunn Capital. But what I wanted to just say was, on the using this filter, is there any, just to give people whet their appetite a little bit, is it possible to give an example of win type of profit percentage, winning trade percentage based on the time frames that you've been showing? I'm just looking at my chart. It's a little bit difficult to see. You're on the 1 hour time frame, I think, on the 1 hour actual time frame. And what is it you're on the PitView?
Well, this happens to just be oil, and
yeah,
we don't track oil. But one of the things on our trade ticket is if it's in a broker's symbol list,
yeah,
we'll go ahead and be able to trade that.
okay,
So we have the ability to, hide the trade ticket if you don't need it. We control it from total view. We also control it by pair view. One of the nice features is you can change a list. You just pick the market watch list, or you can go and just pick everything, every symbol that broker has, and have access to it. So the trade ticket is really designed for everyone. But as I said, with PitView, we're only pointed at over 60 different Forex pairs,
Yeah.
plus gold and silver. Uh, but if you want to trade oil, a broker has it. We can do that. This broker that we're looking at, Core Liquidity, just happened to be one that I'm testing. Um, uh, they're good guys from Australia, um, and so they have indices. So we're able to trade indices on this. Some brokers have stocks, trade stocks, futures. It's really very, very interesting. So
Okay. And what sort of on that method you've just shown? What is that, a sort of type of 50-60% win ratio that you'll be taking on those trades, or have you got any idea of that?
well, it depends upon um, the people, the trading methodology that you're using.
Hmm.
And what we found, and here's really something that I should have touched on that I did not, is you can see that when you're following, and this could be for any chart, it just happens to be for Kiwi. Um, People always like, I mean, I could bring up anything. People tend to like Eurodollar because they trade that the most. So, here's an example of a Eurodollar trade that we would have got into last week, and it had a really good, profit here.
Very
We
nice.
were very nice. You see, we're filtered out this short trade because PitView is above zero. We're filtered out of, well, we might have taken this one. It just barely pierced the line. At the beginning, when you're new at this stuff, you should just you should be trading like a lion trades. Just wait for a high percentage opportunity to come, and then go for it. There's no sense taking marginal trades, because then you're pushing yourself to trade. And if you push yourself
Hmm.
to trade, you're going to wind up losing more often than you should. And so what I'd rather do is avoid losing, taking a trade that's not set up properly. And I'd
Hmm.
rather take that money and go buy myself a gift, like a new putter for golf if I play golf, or a new tennis
Yeah.
racket, or, go out for dinner, go to the movies, take a friend, take your wife, at least get some enjoyment
Hmm.
out of the money that you would have lost otherwise. Because the fact of the trading
Yeah.
is probably 90% of the time you go to look, the opportunity is not there. So it's a game of just being disciplined and waiting. So one of the things I talked to Paul about, and I don't have the graphic, but it's simple to understand, is this. The real value of PitView is, it shows you what the banks are doing. The real value of trading with the banks is that you're trading with the guys that are moving the market. So you've increased your odds already by limiting your trading to only trade in that direction. Uh, that's not to say that you can't make money, the other way. I'm simply saying that you can make more money by limiting your trading, and so here's the key to trading with the banks. So here's the key idea. Let's say you don't have a very good uh, win-loss ratio. Let's say it's even. You win half your trades, lose half your trades. Now, the reason you're making money is because you have everything else in place. You're disciplined, you got good risk management, and so on. And your profit ratio is greater than your loss ratio, your loss. So you have at least 1.5 to 1. Most people would not trade at that level. They're looking for a reward risk ratio of 2 or more. But regardless, so now if you go ahead and avoid a loser, a bad trade, so now you have 5 winners and 4 losers. And so now your win percentage is about 55%. It's moved from 50% to 55%. Now, a lot of people would say, well, what's the big deal? Well, the big deal is that all this stuff is being compounded. We just got a new version coming out of PitView. So the big deal is, and this is remarkable, I was amazed the first time I saw it. I had it confirmed by a quantitative analysis, but a 1% increase in your win percentage going from 50 to 51% has a 22% effect on your bottom line. If you can improve, in the example I'm talking about, by 5%, you've increased your profitability by 150%. So this game ultimately, it's really no different than insurance or the crap tables or whatever it is. You got an edge, and your edge is really, it's simple. Your edge is, well, I'm only going to trade with the big money. You have everything else in place, and these little incremental changes that you can make in your win percentage are phenomenal. If you can increase your win percentage, if you go from 50-50 to 60-40, so you have a 10% increase, you now have 1.5 times more winners than you do losers, which is really nice. You're making money on every trade, statistically, because you have a profit to loss ratio. Take a guess of how much money you'd be making more, how much your bottom line would go if you can increase your win percentage by 10%. Does anyone have an idea?
Anybody have an idea on that one, guys? Just whilst they're answering that question, if we can multitask, Stephen, just for me, one thing, because I always get this wrong myself. On the actual PitView liquidity indicator that you're showing on the bottom of the screen there, when it's above the 0 line, but the indicator is actually painting red and falling to the downside, what we're saying is, this is my interpretation, I may well have this incorrect, and this is why I want to do this live so that people understand what it is.
Yes.
When it's ticking down red, am I correct in saying that actually they're still buying during that snapshot of, but it's just that they're buying less than they previously were? They're taking the foot off the accelerator, if you like. Is that correct?
Yes.
That is correct.
Still moving forward in that direction, but they're moving at a smaller rate. So here's an analogy that I skipped over. And the banks are kind of like these giant tankers out on the ocean. They're really big. They're slow to stop. They're slow to turn around. So the guy in the wheelhouse who's in control of the ship, goes ahead and throws the props into reverse, right? You don't see that. You don't see that ahead of time because you're not. You don't see it happen because you're not in the wheelhouse. Well, it's the same thing with what the banks are doing when they're changing the behavior of the bids and asks. They want the market to move and change direction. Well, they want it to move because they're in different parts of the cycle. I can show you what I mean in different graphics, but they could be now that, just think about it, the bank. They're not going to accumulate positions at the tops and bottoms because they're too big. They're going to accumulate positions around the tops and the bottoms. And so what's going to happen is that they, once they have a position on, let's say they want to turn the market, and so let's say they're pushing the market up, and the problem is now you see that the market price may still go up and PitView is down. So what's that mean? And well, what it means is that they're booking their profits. That's what it means.
Mm-hmm.
And so that's why I said you need to think in terms of how a bank is thinking, and position your trades accordingly. And so it's really important. Now you can see in certain examples like here, the market's kind of flat. You can see PitView starting to move up. They're starting to accumulate things. And you can see that the market just sort of like broke out and took off. Then it went up. They were following the market up, and now they're not totally liquidating, but they're slowing their position down, and they're reducing what they're doing. And now bear in mind, here they're buying, right, and they've accumulated a big position going up. And so now they have to liquidate. And there's one of the things that's really important to understand is what we're presenting, and I talked to Paul about this, is he was showing, I don't remember what chart it was.
Divergence or...
Pardon?
Was it the divergence chart I was showing or not? No.
It was I think we were looking at pound dollar. Let me just switch to that.
Yeah, because actually there's a question from that. I'm just going to pick up, because we need two people for this, because a lot of questions come in. What I'm going to do is just pick up the questions. If you could switch to the pound dollar for the, not the Brexit, the election which we had last week in the UK, because there's a question from Mark, which says, how do we explain the fact that PitView did not show anything whatsoever anticipating the development in the British pound pairs last Thursday before it went south? Well, actually, I have looked at that, Mark, and to a certain extent that may well have been my fault, because I did not use the liquidity. I don't know if you were on the Skype group that evening when we were trading live. But the last hour and a half was quite strong to the upside, which is why I thought they were all positioned to the upside, and that actually the result that I had, they either had their own pollsters or they were some method that they were in front of the activity, which would have had their own pollsters anyway. But is this the move, Stephen? Yeah, let me just finish my thing. So what I'm saying, what I'm going to go on to say is that actually, if you go to the beginning of, take your cursor to the left there, Stephen, actually what you can see is that they were short the entire way for up 2 days prior the actual big down bar there, in the middle there where it really just plummets. That's where we had the gap. If you look at the liquidity indicator, it's well underneath the zero, and it's right at the last minute, just before the move, about an hour and a half before, where it was very, very strong. And I was on the Skype saying this is very, and I was convinced that was what it was. But the mistake that I made was I didn't have this chart up like I did with the previous the Brexit moves and some of the SMB move, for example. So actually, what they were doing, they were completely building a short position for about a day and a half prior. This is the actual cherry on the top of the cake. This is what this can make this tool so special, is that they were putting price up against themselves. Because if you think about it, if you know it's going to fall, where do you want to buy? Do you want to hold the price at the same level where you are, or do you actually want to put the price up against yourself and keep selling some more? And that is confidence in understanding how you're going to trade. And that is
You also make the most money that way, Paul.
Yeah, exactly. But that's what I'm saying. But bearing in mind in one of these places, and that, you know, the sort of sums of money we're talking about are large. If you make mistakes, you will get put out of the door, trust me. And if you make a bad mistake, you will get put out with a black mark on your resume, and the banks talk to each other. So you know, if you do anything fraudulent or anything like that, you won't ever work again. Theoretically, you won't ever work in it again. Although there are examples of where people do get other jobs. But if you make a real big faux pas, a real classic error, then you're going to pay the price. And what's actually being shown here is they were short the whole way up from the beginning of the screen. And that is the mistake that I did not have this liquidity indicator up. There's just a little pop somewhere in the middle there. I can't see the dates exactly because to the left there, where it just pops above the zero line and then pops back down again. And then the interesting thing is, actually, again, that's one thing perhaps should have said. This is this chart, correct me if I'm wrong, Stephen, this is a Heiken Ashie's chart, I think.
I can switch the chart.
What is interesting actually for me also is that the price of the liquidity in the movement of the actual chart of the liquidity indicator matches quite nicely the Heiken Ashie. I don't mind looking at that Heiken Ashie actually, because it's just, I hadn't seen that before in terms of the fact that they almost match bars. So where it starts going red on the Heiken Ashie, the PitView sort of agrees with it. It mostly agrees with it anyway. But you can see also that what's also interesting after that move, so we had the move, the gap down, they were then taking the foot off the accelerator. The part where it went negative, and that was I think the day before the next morning type of thing, before everybody woke up, the London traders woke up, then they went properly short.
Here's the thing.
And again, same phenomenon.
They went short here.
Just there, just there. They went short there, but in fact, again, same phenomenon. They put it up against themselves, and then hit the accelerator. They just trapped everybody in.
Right. Well, how are they going to make money? There's only one way. There's only one way to make money. I don't care what the business is. You got to sell something for more than you bought it. So these guys were selling all the way up. So their average sale price is in here, right? And so now what they start to do is that they know they're about to turn the thing. They start buying everything back. They have all the buy orders in.
Yeah, indeed. But what's even more fascinating is that, I mean, what you say is true, but however, you could still make money by selling constantly at the same price and buying back at a lower price. But the extreme confidence and ability to control the market means they put the price up against themselves. And that's what I'm saying. That is the cherry on top of the cake. If you want to have a good deal, you know, sell and then buy lower, obviously. But if you want a really good deal, you put the cherry on the top of the cake with the cream on there as well, and that's what's being shown on the chart. Actually, that's my opinion anyway. I mean, it's actually, you know, it's very, very interesting to see that. I don't know if I'm just going to go back to that question. Does that answer the question on that, Mark? Just because I'd like to just go through all the questions.
The key thing is PitView has nothing to do with price. It's all behavioral analytics that took us a long time to figure out. What we're doing is tracking the way, and I hate to use this word, but how they manipulate their bids and asks, you know. Now,
indeed. Let me just one thing, sorry, Stephen, just to interrupt, just 1 second. Just also to clarify one thing about actually the market, because obviously that's what I'm involved in on a daily basis. The majority of the market, and a lot of what I actually do is client business, which means to say that you have a company which comes in, could be a company which is a European company which needs to buy T-shirts in, I don't know wherever it is, but various companies, could be a commercial company, but a BMW buying spark plugs in the US or whatever, and those are the majority of the transactions that actually have to take place. So 80% of that market, as Stephen said, is controlled by the banks, but then about 80% of that business, of their business, is actually commercial, and they're not really so worried about what price they actually do the business. So we'll get an order which comes in and says we have to buy 40 million at no more than this price. That's actually what happens in a physical, in a physical day. Part of what I'm doing is that, and then we have to fill that order. That's what we call fill that order. Go into the market, buy a million, till you fill that till you get to the 40, and you mustn't go above that price. Some days it means that you might not be able to hit that order because price goes up or whatever, something happens. But that is a lot of what happens in the market. But there is a cherry on the cake is the fact that because it's mostly commercial, the speculation part of the FX market, it's so much easier for them to win in speculation, because if you compare that with the stock market, and I've put this argument out before, maybe for new people that haven't heard it, if you go to the stock market, it's 100% speculation. Nobody goes there to do business, to transact business, to trade or anything like that. It's 100% transaction, the speculative. You want to buy at a low price and you want to sell at a high price. So the best minds in the entire world are in the stock market. That's why the FX market is easier, because it's 80% commercial, and they're all worried about, we've got to get these orders in. We've got a company that says you need to, you got to fill this 500 million. It's got to be done by 3 o'clock. So everybody's got to hit the phones, or it used to be phones, and you've got to get that stuff ordered, get it out there, and it's just get the job done. We're not worried about what price it is, as long as it's underneath the level which they want to get filled. But that means that the remaining 20% of that bank order, the main FX dealers, those are the people that can actually push the price around speculatively and actually trade the bank's money in order to make this market, which is what's now being described. So that's just a little nutshell. Sorry to take over from what you were saying, Stephen.
No, that's fine.
But I hope that explains. Sorry, because I want to actually make sure everybody's answered, because okay, Mark's saying yeah. Okay, so but if there's anything else more like that, Mark, don't hesitate to to send a question or whatever to myself or to Stephen, because again, I made that mistake on the evening of thing, and I actually got a little bit in problem around about 3 o'clock in the morning, trying to trade this thing on my own account. I ended up having 120 trades that night. I did actually make quite a lot of money at the end of the day, because I had to switch to get short on that London Open. But you do need to have effectively the whole tool open to have a look at it and go actually very carefully. And I made that mistake myself because I was slightly rushing. But that is probably one of the reasons why you didn't see that. So, okay, let's just move on quickly to the next question. Okay, we got, okay. So the success of the percentage success, Osmo was saying, okay, he's missed the answer. What I'm seeing on there personally, Osmo, is what I'm seeing is probably, what we're saying is, it seems to me there's around about 30% of those trades that you see on there are probably relevant. Is that right, Stephen? From what I've seen so far, means you're hiding in the bush. You take 30% of what's on offer, something round about that. And what I'm also seeing, I would suggest, again, I don't know, I don't have stats on this. Maybe Stephen can correct, but looks to me that probably more than 50% are successful. Some, and people know that I love to hold trades. And that's just one of the other secrets of success. Some of them seem to run very, very well. Others, you probably seem to be run about break even, or you make a few pips, or maybe a slight loss. I don't know where you would stop out on some of these trades ultimately.
Well, my favorite way to stop out is with a trailing stop.
Yeah, indeed.
I just look at it this way. I like to trade longer time frames, which means there's less opportunities. So I looked at it, and maybe I had 2 opportunities a month, on average, to put a trade on. And that's
two per month. On what sort of time frame would that be then, Stephen?
Like 4 hours. I became a student of Tim. I learned a lot from him. He changed some of the way that I look at things.
Okay.
I've been trading since the mid '80s, and I'm very, very good in terms of discipline. I solved those problems a long time ago, and it was a question of developing some really good habits. I've been very, very good with risk management from the get-go, and it's just a question of being particular and waiting for the right setups. And
Okay, but
that's the whole key.
just on that example then, so post this election, so in the middle you got a short trade which looks like probably, you know, break even or slight loser, let's say in the middle, that one
This
there.
one, yeah.
Would you have taken that one?
This trade,
Yeah,
no, because
it's still
PitView is
above, is it?
above the
Oh,
zero.
okay, yeah, okay, I see it now. Yeah,
See,
yeah,
the conversation that we had, if you remember, is what we're trying to do is walk before we run. So
yeah,
what I'm trying to do right now is to teach PitView 101.
yeah,
And there are plenty of ways to get into PitView 201 and 301, but you got to pass PitView 101 first.
yeah,
And so PitView 101 is going to give you less trading opportunities, but the trading opportunities will have a higher likelihood of succeeding.
yeah,
Now, I think it's reasonable, and I've seen this. Uh, it's reasonable to expect to be right twice as often as you're wrong. And my experience has been that kind of like in any other business, you will have windfalls, but the windfalls come, um, they're unexpected. You don't know what's happening. And I like to put it that a guy who's just sticking to a plan and doing his job and pulling money out of the market, that once or twice, sometimes even more than that a month, the trading gods will come and bounce your account up 3, 4, 5, 6% or more. You know,
hmm,
it just happens.
yeah,
But it doesn't happen unless you're doing it. And it's sort of just again like poker, the analogy, or anything else. You just have to put your small bets in there, and your small bets, as long as you're making profit, you know, then these runaway, these gifts are going to take you over the top, you know.
yeah. So just to finish on the screen then, so from the two on the right there, those two green, I'm just trying to give the guys some examples of what would actually work to the two further on the right, which are above the moving average. So if those two there, those two probably would have taken them because it's above the zero line and it's above the average. Is
Yes,
that's correct? So they would have been certainly
yes.
the second one would have been quite nice. And this,
This would have been a winner. There's no
okay, yeah.
question
And
about that.
again, just for my benefit, because I can't see it, I've got a very small screen here. That's a 1 hour time frame, isn't it? We're talking about.
Yes.
Okay, so you've
Yeah.
got some potential. You got some potential. I'm just trying to see how many
Well,
pips that would have
this
run.
idea works on any time frame, Paul. It's just a
Yeah,
question of how you want to trade. You know, I'll
yeah,
just pop. Well, what I'd want to do here is make an adjustment in PitView. What
yeah.
we found. Let me just go back here. What we found, and this is just empirically, that what works best is uh, having a longer PitView. Now I know, like,
24 hour that is on the bottom there. Just a note for the guys, isn't it? I think.
right. So I use
Yeah,
24-hour for 1 hour and also for the 4-hour bars, you know,
yeah.
and that seems to work well. I noticed that with what you were doing, you were also, you know, uh, in uh, in a um, doing
Quite
like
often.
5 minute bars with the 4-hour PitView.
Yeah,
Same
five with the
idea.
four. Yeah, yeah.
Same idea. You know, because
Okay.
what you're looking for is the smoothing factor. You know, that's what you're looking
Yeah.
for.
Okay. I've got actually just a question because again, I don't want to. I'm conscious of the fact we've gone on 1 hour, 18 minutes now. But if everyone seems to be still here, which is good, I just got a question here from Mike. It says, "Can you tell us how to use PairView for the 1 minute and 5 minute time frame?" So maybe
Yeah.
just to switch to that, if there is an example.
Well, there's no guarantee that there's an opportunity.
Yeah. But it's just to see what it would actually look like. But what I think you're going to say is that it's conceptually the same thing. So what you're
Well,
doing is you
no,
actually
it's different,
okay,
because here's what we're doing here. And let me try to make this bigger. I don't know why it doesn't want to get bigger. Let's look at Eurodollar. There we go.
Yeah.
So here's the concept. LP22 for the last hour is, and I'll just do this right now.
Yeah.
It's they're controlling about 36% of the market,
Mm-hmm.
and they have a bias to the downside of 19%. That bias, what that means is, let's say it's 20%, so we can do the math.
Mm.
That's simply an arithmetic difference between the activity on the bid side, the S side, and you subtract the activity, from the bid side.
Okay.
So since this is negative, that means that the activity to the bid side is the bigger number. And so what this means, to get the 20% difference, it would mean that 60% of the activity is to excuse me, I got that backwards.
To the ask side, you mean? Yeah.
Yeah, to the S side, and
Yeah.
and 40% to the bid side.
Yeah.
So what's happening now is what we're looking at. So what you're talking about before is the normal course of business.
Yeah.
So the normal course of business is one guy selling and the other bank's buying and another guy selling.
Yeah.
And then when you add it all up, not much is happening, right?
Yeah.
Now, this is a crummy time of the day. No one in their right mind should be trading, in my opinion.
No.
Because at the markets are closed. Who trades Sydney, right?
Yeah.
So what you want to do here is you'd want to change your time frames. So the easiest way that I like to change time frames is through total view, because everything's all linked together. So if we want to get down to like the 1 minute time frames, this thing is got to sync it to pair view. We have infinite control of things here. So what we would be looking for is an opportunity where the LPs are all lined up in the same direction.
Mm-hmm.
What we're looking for is times when they're not doing business with each other, when they're not doing the normal commercial business.
Okay. Yeah.
And then the way we handle that is, and different guys have come up with this independently, the same solution. So I don't like trading very short time frames. A lot of people do. So what you want to do is wait for the top, let's say three guys in a row or 3 out of 4, all to be pointed in the same direction that you want to go in. And that this value here, the bottom number here, is 20 or more, and it stays that way for at least 15, 20 seconds. There's a delay in it. Now, there's another thing that also people don't understand about PitView yet, is that it's a rolling calculation. So if I'm looking back for a minute, I'm looking back at 60 seconds from now. Okay?
Mm-hmm. Yeah.
And if I'm looking back now for 60 seconds, it's from now. It's not from 10 seconds ago. When you look at a bar basically shows you what's happened since the starting gun was pulled, which was the start of that minute. So 10 seconds later, you're looking at on a 1 minute bar, you're looking at 10 seconds worth of information. At PitView, you're looking at 1 minute's worth of information. So it's different. That's another reason why it's also more sensitive than price, because it's a more important than price is because it has more information in it than your price bar does if your price bar is not complete.
Yeah.
Do you understand what I'm saying?
Yeah, I do. And do entirely. Yeah. Yeah.
Yeah. So that's how people are using PairView. One of our guys, Brad, I don't know if you know Brad.
Yeah, I do know him. Yeah. Yeah.
Yeah, he loves to use PairView. He loves to do short-term trading.
Yeah.
He's one of those guys that has to be doing 10 things at once. That's Brad.
Yeah. Yeah.
So what he'll do, he loves to trade around news events. So what he'll do is he will try to determine what the trend was before the news event. And he's looking for a pullback in price away from that trend.
Mm-hmm.
And then he's looking for the LPs to get back in line to go back with the trend. So he said, doing it that way, he's very, very close to picking bottoms. And he says it's like shooting fish in a barrel. And there are people that are getting 7 out of 10 trades, 8 out of 10 trades right by being patient and looking for the right opportunities. Okay. It's all about numbers, It's all about numbers.
Okay, that's interesting. So I don't know if that answers the question for Mike as well.
There's no activity.
Okay, I was saying, how do central banks fall into the picture? Remember the Swiss franc crash. Excuse me. Actually, one thing on that one, very, very good point, interesting point, and I can tell you a couple of facts on that one. Firstly, a lot of the UK banks, for example, Barclays, lost, a couple of things. A lot of the UK banks actually lost a lot of money on that day. But when you see how far the Swiss franc actually moved, the amount that they lost was not actually commensurate with the amount that you would have thought they'd lost, based on people's estimates of actually how much they had in the market at any one time. Because bearing in mind what actually happened was that was like someone just pulling a carpet. Everyone was just trading. Someone pulled a carpet and then you fell on the ground and you basically whacked your head on a piece of concrete and had a very, very bad fracture of your skull. That's what happened to the central banks. They lost Barclays. They lost 150 million in about 10 minutes because there was no market. And that's two things. Firstly, I'll come to answer your question. That 150 million, it sounds like a lot of money, but actually when you see what they make out of Forex, that proves that they are trading extremely responsibly with regard to risk control, which is what I was even talking about last night and Stephen was talking about tonight as well.
Right.
They're not nearly as heavily exposed to the market as people imagine. Because that move was phenomenally big compared with standard deviations and all the rest of it, but they only lost 150 million. To answer the question directly, there is a chart. I don't know if you've got that. You won't have that on you right now, Stephen, but there is a chart.
I'm looking for it right
now. Okay, I'll keep yapping. There is a chart of the when it actually happened, about 3 or 4 days before it happened. You had the same phenomenon that just happened with that UK election, to the extent that the PitView guys thought that the algorithms were broken, they were no longer working, because they were selling the whole time. That is because the Swiss National Bank had informed the Swiss banks only of what was going to happen, and they were getting short to make sure that they could obviously profit and buy back when they pulled the carpet and everybody else took the pain. Now, the reason why they did that was because they'd spent billions of euros, spent billions trying to defend the euro at the expense of their own currency, which put some huge pressure on their own balance sheet, which is still, this pressure is still there on the balance sheet, in fact, and they wanted to make sure at least everybody was a winner in Switzerland during that episode, and to hell with everybody else. What was interesting about this, and this is again the cherry on the cake, and it proved that things had actually changed in the Forex markets. What normally happens on a Friday is most people close out vast majority of their positions. I'm not saying that everybody closed out 100%. They don't. But the banks need to, especially since 2007 and 2008, at the end of the day, you need to be flat generally, and certainly on a Friday, you need to be flat generally. Here's
the event, Paul.
Okay, I just finished this Spurs. Another 30 seconds. What actually this meant was what the reason why they do this. This is an unwritten law or an agreed law, an unwritten law in the forex markets that people will be told in advance, that CEOs of these people will be told in advance that we're going to make an announcement at 3 p.m. on whatever day it is, and mostly they can work out what it is they're going to say, and they can par their positions down just like we all par our positions down before NFP and all the rest of it. And on this occasion, they completely broke protocol because the guy stood up at 11 o'clock in the morning, and he did with no warning whatsoever, and he said, right, we're going to lift the peg, and that's what they did. That was unprecedented. That's why we have the move, the move that actually took place. So this, what Stephen is showing now, I'll pass back to you, Stephen. You can explain exactly what it is.
Yeah, this is the event. We call it the event.
Yeah.
So here's Euro Swiss. It's pretty much flatlined, right?
Yeah, because it was a peg. Yeah.
And look at the imbalance, all the imbalance, on, pardon me, leading up to it. I mean, this was like a zig and zag back and forth. But here for over 2 weeks.
2 weeks.
For the event.
Yeah. So that was planned. That was planned. That was absolutely planned.
That was not an accident.
No,
right.
That was planned, and they all knew about it, UBS and the rest of it, because it cost them billions, and they wanted to get their money back, and everybody else was going to pay.
Right.
It's a very dirty game, FX. I keep telling everybody it's one of the dirtiest games on the planet, and that's the way it works.
Well, but see, PitView, their behavior is not hidden from us. I mean, we see this, and so the real trick in using it is don't think of it as being anything to do with price. It's behavior. We're tracking what they're doing, And so you got to start thinking like, what would I do if I were, a bank, And so they got this huge position they build up, right? The market tanks, and then they start buying it back again. Now business goes back to normal, and they start pushing the market back up.
Yeah. Yeah, just to interrupt you again to answer your question, because obviously on the my experience on the inside of the thing, think like a bank. What is the objective as a bank? They just want to make as much money as possible. I mean, that's how it works in reality. And you can see, for example, in the US currently, they're rolling back all the Dodd-Frank and the rest of it. All the regulation is being lifted. The proprietary trading regulations, which they put on with Dodd-Frank's, also being lifted because they want to get back to normal procedure. Just one question to the left of that move, though, Stephen. How would you explain everything? The three big bars, the three those ones there. How would you explain those three there then? And how far before the event is that? Is that a month or something?
Well, these vertical lines are weeks apart.
Okay, so that's 1, 2, 3, 4, 5, 6 weeks apart.
5, 6 weeks ahead. It's hard to tell right now because this is really a blown out scale.
Yeah.
So you'd have to look at things, kind of normally, but
is that possible? I mean, again, having worked in I know how bureaucratic it is when they need to make a decision. Is it possible that this type of thing would have to have been decided, obviously, with the chairman of the SMB to start with? Maybe they wanted to do their own stuff, get short there to begin with, and then they gave the retail banks, UBS and the rest of it, who they will obviously talk with on a daily basis. They gave them 2 weeks to get into the market after they'd filled their boots 6 weeks prior, or 4 weeks prior.
Yeah.
Because this would have had to have gone via committees and all the rest of it and signed off, and you know how it is. I mean,
right.
You would have compliance people, everybody would have to have signed off and sworn to secrecy, of course.
Exactly. Well, what would you do if you were a Swiss banker? Would you come in?
Yeah. I mean, you'd want to get it back up because it's also the guy's reputation. I mean, you have to see, for example, with with, I mean, it's not so much in your neck of the woods, but with Draghi over here, I mean, these people are ferocious about their own reputation going down in the history books as being the guy who has saved the euro. I mean, they're not worried. I mean, they've got the money. They made their money already, but they want to be the big shot that was the guy that, called it as it is, told everybody how to do it, knocked everybody into shape, and then saved the euro. That's what they want. And I guess it's the same thing with the Swiss franc here.
Yes.
So, but that is an interesting, I don't know again if that answers, I forget who that was who answered the question there. Is that to Osama? Does that answer the question on that? For me, this is absolutely fascinating stuff. Right? You can tell I get pretty excited about this because it is very interesting to see how it, yeah, he says, thanks very much for that explanation. Thank you. Why didn't others make some? Very, very good point, because they hate each other. That's it, Stuart. They hate each other. There's no love lost. That's why I keep making jokes on Twitter and everything about my friends at Barclays. I mean, they had all this business about the LIBOR and everything, where they collaborated to a certain extent, but that was to collaborate at the expense of basically other companies, but it was because they were all in bed together. But yeah, I mean, there's also, if you look at the recent stuff going through, if you look at a guy called Peter Siver, Siver on Twitter recently, he actually was a whistleblower, and you'll see what he's talking about Barclays at the moment because they're in court again. But they hate each other. There's no love lost between those banks. So if they can steal the best trader from XYZ Bank and get one over on UBS or something like that, they'll be only too happy to do it. It's a real dog eat dog. It's very primeval in terms of capitalism and all the rest of it. You can't get it. I think the pits obviously were the true example of pure capitalism in its rawest form, but this is one of the next forms, if you like. I've just got some more questions here. Okay, I might have missed this one. Okay, so this is from Mark. When the banks are selling, the others are buying. Absolutely, yeah, right. So when price goes up, long position we want to be in, it just means that the banks are selling. So how does this correlate to the PitView window shown in your example? So again, I don't know which window would that have been. Maybe that was the British pound. But generally, just to explain to Mark, generally what Stephen is saying is that, again, the price can move in the opposite direction to the liquidity window. And what he's doing to avoid, because this is the trap that I've fallen into. I mean, I've made a lot of money on divergence and stuff, and then all of a sudden divergence doesn't work, and it gives you start to lose confidence. But what Stephen has actually added, I'm a bit miffed I didn't come up with this myself. What he's added is the fact that it's just got that moving average. So if price is going in the right direction above that moving average and the liquidity window is above the zero line, then you've got potential for a trade. Now, I personally, again, because Stephen has said that this is PitView 101, I would be trading a lot more frequently, and I'm not going to say what I would actually do because I don't want to confuse the matter, but given what is showing now, I can see at least a couple of ways to where personally for my particular trading style that would be more my style. It doesn't mean it's good for you or for anybody else, but what you gain in confidence is the fact that the indicator is above zero plus price is above that moving average, that 50 EMA. And that is, I think, what your question is. Now, hopefully, that will answer it.
Here's an example of something. So price is coming down, right?
Yeah.
And it's falling, and then these guys really start going to a long position here.
Yeah.
Okay, and so price goes up, it goes up, it goes up. They're still buying, right? And then they start to sell a bit here.
Yeah.
And they're still on the short side as price goes up. Well, people say, well, that doesn't make sense, right?
Mm-hmm.
But
yeah, because I've had these examples. I've had these examples myself.
Where are you going to liquidate all your buying, Paul? You want to liquidate your buying. You start selling as price is going up.
Exactly. Yeah, exactly. Because the ultimate thing is, and I've said this time and time again, when you go into a big resistance point, the last buyers are the worst buyers, and that's the point when the banks have actually almost entirely offloaded their long position, and they will be switching to the short at that point.
Yeah. This is the point that we just need to hammer with people, that PitView has nothing to do with price. It's bank behavior, and these guys can only make money selling for more than they bought. So where are they in this buying cycle? Now, often what you'll see, this isn't a particular example, you can see they start pushing it up. They're buying back their shorts here.
Yeah.
They still say short as the thing goes up.
Yeah.
They're still staying short. Then they go into a buy position here. So maybe they're just doing business here. They're not always changing positions. But then we can see down here, they went zero.
Yeah.
The price is flat, right? And they went below zero. This is a warning to be alert, okay?
Yeah.
This is a warning to be alert. And so, that's what happened. And this, the chart's blown out, but this looks like a buying opportunity, a selling opportunity right here.
Yeah.
Got good criteria, would have had a nice run in it.
Yeah,
so here,
but what I quite like about your method with this moving average is it actually keeps you out for a PitView 101. It keeps people out of standing the wrong way, because the problem that people have is that they don't understand why the price is still going up and PitView is still showing underneath the zero line. And I've had this problem myself. I can freely admit that, because it takes some time to properly understand the tool. And even though I understand how the market works in terms of which way how they're going to push it around, but what I think people have got difficulty with is imagining that they can push price in the opposite direction to the what they're actually doing, and still be in control of the market and be able to move the market maybe a day, 2 days, 3 days later even, and actually cash out maybe 3 or 4 days after that move's actually happened.
Well, here's the theory I have. These banks are worth, I don't know, tens, hundreds of billions of dollars.
Oh yeah.
They didn't get that way by being dumb.
No, absolutely. There's a lot of rogue. A lot of it has been acquired via rogue practice. But we're not going to go down that road. But you know what I mean. There's still a lot of that going on. I mean, the client pays basically.
You had told me before that the kind of insight that we're providing with PitView, you don't have available at the bank.
We don't have any proprietary software like this to do this type of thing. No, it's pure matching software. We just need to match the trades.
Right.
There's no insight in terms of this. There's nothing like anything like market delta or anything like that, which is available for retail people. They don't really use any of that.
So the beautiful thing about this is we're at the start of PitView. I was very particular in getting this to a point that I felt was good. Where it got boiled down to the essence. I had some help cutting out too much information.
Yeah.
And so one of the beauties is that the people that get involved now are the ones that are really going to benefit the most. And it's just during this time of early involvement where the sharing of ideas, where one person gives an idea and then another person thinks about it, improves upon it, shares it back, and it continuously gets refined.
Yeah.
So I'm very excited about this.
Yeah, no, it's good. I just got another question here. What do we think about Renko charts? Have you thought about substituting Heikin Ashi with Renko ATR? I don't know if that makes any difference to this, or I don't know if you have anything to say on that one. I actually, I'll be absolutely honest. I'm again, I don't want to muddy the waters on the presentation or anything, because Stephen has presented the Heikin Ashi, but I think you did demonstrate you can switch them. I don't like trading off bars which are not actually representative of true price, because this stuff is it's the estimation of I need to actually see the price, otherwise I don't know what price I'm going in at. That's my problem with Heikin Ashi.
That's why we offer different templates.
Yeah. Okay. Yeah. I like to actually see where is that price, what's that bar actually done, And then, for example, where it drops off the underneath the moving average there, it's beautiful to go short there, with PitView or without it. In fact, to the right there, where it goes a bit more to the right there, on the right, but after the move to the downside there. That just a bit to the left there now, yeah. But I think just to answer the question from Mark, I think the charting package is a very personal thing actually. What you actually feel comfortable with. I know there's a couple of people, exact trading guys, who have used Heiken actually quite extensively, and I think they're doing very, very well. Last I heard, they seem to be doing very, very well using it, because it does smooth, and certainly some of the currencies like British pound, but I think they trade British pound, Japanese yen from the charts I've seen which they've posted. And that seems to work very, very well. It just depends on the currency pair. But I personally, it's a bit of a question that you can't teach an old dog new tricks and the rest of it. I'm more of a price person, or tick chart actually is also my thing. So I've got a question from Olivier. It says 4-hour time frame trading, which PitView liquidity indicator time frame will you use? Okay, so yes, I think the answer to that was, if you have the 4-hour time frame, Stephen, you would 24, yeah. And that actually, what this does do, and again, it's good that we've had this webinar, because it's opened my eyes to a huge amount. The 24, I think I was nearly there with the 4-hour against the 5-minute, but this is actually 24 is very, very smooth.
Yes.
You can see once it gets, because on the lower time frames, and this is not a criticism of the tool, it's just a function of the way things work. Sometimes we went above the zero line, and we went underneath the zero line, then up and down and up and down, and it's quite tricky to know when you are properly long and properly short. But whereas with this 24-hour, it does actually appear that once you get into that trend, you can see where we're looking at, that the swings on the actual liquidity indicator are pretty good, and that it swings to the downside, it curves, and then it comes up and goes through the zero line very, very smoothly as well. So, and you can see it's just gone through the zero line to the downside now, and that looks like we're probably set for some possibly some downside activity tomorrow.
There's another thing also, Paul.
Yeah.
This isn't brain surgery. I mean, we don't have to be within micromillimeters of something.
No. But we all get too close to the market, and I'm probably guilty of that for sure.
So the whole idea, and I find that when you put different time frames up and compare like a 24 versus a 6-hour, there's not a lot of difference.
Okay.
But you have to prove that to yourself. There is some difference. There's not a lot of difference.
Yeah.
Is it going to make a difference in your outcomes? Probably a little, one way or the other. I'm not sure which way.
Okay.
But the main thing is, is the foundation a good foundation? Is the way of thinking a good way of thinking? An approach to trading, and just to bear in mind again, because I see it's a hurdle, that PitView has nothing to do with price. It's all about behavior.
Yeah, indeed. Yeah, it is indeed. I just another question again. Sorry, tell me if you need to pack it up, because I'm just looking at we've been going 1 hour 40 minutes. Everyone is still here, so obviously they're all glued to the conversation. But just want to try and pump as much information out of you as I possibly can for people. Do you see any difference in the how do you say that? I'm speaking French. The behavior of the market makers in terms of the pattern that is actually drawn on the chart with the liquidity indicator, because I thought that I detected that certain currency pairs seem to be more machine generated market making activities, certainly at certain times of the day, and other currency pairs were, I would say, perhaps slightly smoother than that. Is there any nuances there which are worth looking out for? Do you have any idea of,
Well, there are, but I can't say definitively.
No, okay.
But I have observations. For example, I'm learning from our users. Like, for example, one of the things that was pointed out, if you look at pair view, most of the time it's the same top tier banks that
Oh
are
yeah, it's just usual suspects. Yeah.
the usual suspects.
Yeah.
They will, if you notice, depending upon the session,
Yeah.
whether you're Sydney or Japan or Europe or US, they
Yeah.
take turns, having more of a dominance in the market or less of a dominance.
Yeah.
But one of the things, one of our users is one of the guys on the bottom of the list, stays at the bottom, hardly is ever in there,
Mm-hmm.
comes in. When he comes in, he's right like 90% of the time,
He's
So,
probably got a client order, which he wants to get in. He wants to get in front of the client order first, and then hit the market with the client order.
would a bank do that, Paul?
Oh, absolutely, all day long.
I'm just kidding.
Absolutely. Yeah. No. Oh no. Yeah. Absolutely, all day long. Yeah. Yeah. Poor client. Poor
Right.
client. Yeah. No. I mean. Yeah. No. It's not. Again, I repeat, that is not illegal in FX. It is in the stock market. If you're a specialist on the New York Stock Exchange does that, I think you can get done for wire fraud or something, or whatever they call it over there. They have these funny names about wire
Probably
fraud.
get
And
locked
stuff.
up.
Oh yeah.
Yeah.
Yeah, for sure. Just a question. I got one here from Osama. He says, "Can we make a 21 MA?" I mean, I guess that it's the same. I don't know what you have there. A 50 and is that a 50
Yes.
and a 20? Is it a 50 and a 20?
Here?
The
Well,
moving
this
averages.
is just a different template for a different strategy.
Okay, it's just a
So
different template. Yeah.
we give a couple different templates. I mean, if what I'd like, Paul, you come up with the template, we'll add the template to our PitView package so it'll get distributed to everyone.
Yeah,
You know,
indeed. Yeah. Because my philosophy is the more people that can take some money off the banks, the better. I mean, as you said, they've got hundreds of billions. So there's enough to go around for everybody. People are
they
very
won't
surprised
notice
when I
it.
say this because they think it's a scam or something. But there's so much money in there, you can't possibly take. You couldn't possibly trade them to death. I mean, it just doesn't work like that. There's enough money
Right.
to be. There's also enough people around who are not going to be profitable, unfortunately, because they're. You have that learning curve which you spoke about in the beginning, and it is a long learning curve. It can be 2 or 3 year, 5 year learning curve, and it can just take people out of the market to the extent that they never come back. It depends how much stamina that people have got, how much money they got to capitalize their account, how much education they're prepared to actually take themselves to find a method that works. But the market is always going to be there with
It's always going to be there. I
pots
mean,
of money.
that's one of the reasons why I'm such a strong advocate of risk and money management.
Yeah.
And our trade ticket was developed for that. And it has a bunch of other features that are built in to avoid doing dumb mistakes. It won't let you do dumb things.
Yeah.
We
Indeed.
put in traps.
I've got another one here from Mike. He says, is it possible to have depth view show a numerical imbalance for a quick 2 to 3 pip trade? I guess what that is, it's probably based on some of the videos that I think I made with the very, very fast trading. But I think what you've said is that actually when 3 or 4 of them line up, and this is the question, just again to explain to people, because this question hasn't come up, but I think it is relevant. If you got the top three lining up, you're talking about 75% of the market, or possibly even more. At that moment in time, there really is no market because everyone is facing the same way. And then actually what you will get is a gap. You'll get a liquidity gap because no one wants to take the other side. And that's how the price actually moves very, very quickly. And it just zaps through any stop losses and everything which are there and fills until it gets to a point where the liquidity is there again, and that's why you get these sharp moves.
One of the things that we have the ability to do is we have the ability to create alerts based upon market maker activity.
Okay.
So you could go ahead and say, okay, well, I want it on the totals row, or I want it on a certain LP. And, once it gets to a certain level, value, we want it to go off.
Oh, that's very interesting. So what could you do? Just again, I'm talking out loud. I'm hoping that this is interesting for the guys. What could you do in terms of, for example, the example of the 3, the top 3 sitting one way or another? Is it possible to define that?
I don't have that level of granularity, but I have the level of granularity to tell you when this is happening based on a certain time frame.
Okay, and does that send an email to the iPhone or something, or what does that do? Is it
It does whatever you want it to do. It goes to your mobile
GSM then?
phone,
Yeah.
you know.
That's pretty cool. That's pretty cool. I
Yeah.
didn't know about this.
Well, now you do.
I've had to, I've had the thing on my desktop for, yeah, this is, I'm a bit of, a bit of a busy man, and that's it. But that just shows you not studying the product correctly. Okay, so you can actually set that up. So if I wanted to set something up, it says, okay, send me an SMS when this thing is above 60 green or something like that. It will send me an SMS.
Right, it'll do that.
Wow. Okay, then you have to be pretty quick to get your trade on, but it depends on what time frame you're actually using, of course, at that point.
Yes, yes.
Okay, that's also very interesting. We got a few people. What's the cost? Oh, cost. Yeah, I don't know. Well, yeah, actually, that's another thing. Just because we've probably gone on a little bit too long now. It's coming up to 2 hours. I probably won't switch back to my slides, so I apologize to the people that have actually sent the questions. We'll do the questions maybe offline or on a second webinar. There's 2 questions actually. Sorry, I apologize in advance to those people if they're not happy they haven't got the question. But what I did want to know is what is the development actually that's going on? Because the other night when we spoke, you said there's some development going on and they're changing the website around a bit and maybe taking some parts of the tool off and adding new bits. Just so to explain to people how that would.
Well, we're interested in success, you know.
Yeah.
So one of the things that I'm a strong believer in is this is designed for human beings. So we want to keep it as simple as possible, and we're throwing away things that we don't think are necessary for people to be profitable.
Okay, that's good.
If they're focused on things that are distractions, it's going to keep them from being profitable, and that's not what we want to happen. Okay. So we believe at this point in time that someone can make an awful lot of money with the 3 things that we offer, which is Total View. Total View, it's a fast way to look at the market. You wake up and you wake up and in a glance, you can see where the market is. You know, the entire Forex market. You don't have to open charts or anything. You get something that's interesting, you go ahead and just double click on it. Yeah. And the chart takes you as change right there. Okay. Yeah. So the opportunities for trading are when things are out of whack. You know, when things are in equilibrium, there are no trading opportunities. So you're looking for things to get out of bounds. This shows you an instant, you know, what's out of bounds. So look at the top left or look at the bottom right, and they'll take you, you know, that's the area you should focus on. So that's simple. Can't get any simpler. Then the other thing is the graphic of PitView, you know, the liquidity window. That's important because it gives you a frame of reference for what's happened in the past. And then pair view is great for scalping. You find a pair, you know, you look at the time frame that you want, and that's how people use pair view, the best way for scalping. And everything builds up. We take LP1 and 12 and 9 and 2, we add them all up. We get the value here for the entire that contract. We take this contract here, and so we're looking at the 24-hour thing, and we can just look here, and we'll just show a different view. Here are all the numbers, you know. So you hover over it, you see, okay, well, that's pound yen. So you can see the value here is reflected here. If you're a numbers person, if you're not a numbers person, you just look at the graphics, and you know, the shorter the time frame, the more intense the colors can be, the more things can be out of whack, you know? Yeah. So those things are enough, you know, to get you positioned properly and get your head thinking in the right direction. Then you got to think like a bank. Yeah. Just one last question on that FX, on the pair view. Because we had this question that came up some time ago. Do the banks
how to explain this? Are the calculations weighted based on the percentage control that they have of the market? So what I mean to say is the top guys is showing, what is it, 15%? I can't quite see it. Is that 11% negative? He's got 40.97, I think. Well, whatever he's got red against LP34. Do you
Okay.
say that LP34 has more weight than the guy at the bottom who is actually only got 0. Is it 36
Yes.
or
So
56?
the answer is,
Yeah.
again, this program has a lot of depth to it,
Yeah.
and so we're going to get better at presenting it from our users. But here's what we call our net percentage view.
Yeah.
If I click on here, this is a weighted view. And so now
Okay.
what I've done is you can see that their percentages is the same. So this is a measure of their impact. It's a combination of what percentage they have, multiplied by their bias. Okay. So
Okay.
that gives you a different look at the same information.
Okay. Is this documented anywhere though, Stevens? Just to understand it, because I must admit I
Yes,
didn't.
but
Again, I probably missed this. I mean,
well, here's the big improvements that we're making. We're working on actually turning in this everything we have into a course
okay.
where we will put it together what we call lesson plans, and based we'll be able to keep track of the plans that you've gone through and take you on to the next plan.
Okay.
And so we're building it first at, I guess, the best way, again, at a 101 level.
Mm-hmm.
And then we'll take that and go to the 201 level. We'll go into more depth on each of the features.
That sounds very good from point of view of keeping people on the right side of the market. And what would you say, just really to final, because I think we ought to knock it on the head shortly. The 101 method would be the method you really described this evening, using this 4-hour and the 24-hour PitView. That would be the first type of thing you would suggest people should pick up, presumably.
Yeah, I mean, look, you've gone through this. I've gone through it. You know what it takes, to,
Yeah.
and so what we want to do is keep people on the high percentage side and control their risk with the money and trade management.
Yeah.
And those are the keys, because psychologically, at the beginning you have no confidence in your system. How could you? You don't have any experience with it, right?
Yeah. Yeah.
You can have confidence in the system, but how does someone who's not done it themselves translate someone else's confidence into their own mind and body? You can't do that.
True.
So the best way to do that is take a path that maximizes your likelihood of being successful. And that's what we're trying to do.
Okay, that
Because
sounds very
we
interesting.
believe, we're convinced, we know that PitView, provides an edge that people don't have. And it's a valuable edge if you use it properly, know how to use it properly. And so that's our task, is to be better teachers. And that's what we're working on. Those are the major improvements we're making. I think I'm very comfortable with the level of development of the product right now.
Mm-hmm.
And so the improvements will be in educating and helping people understand how to use it and to actually use it.
Yeah, no, there's nothing better than if you have on a website, you've got people, with good testimonials about saying they've made money with it. Then obviously for you, it helps to promote your own business and bring in more people and more ideas and the rest of it, because ultimately that's what it's all about, isn't it? I just got two quick questions here. Finally, Troy said, what is the cost? Again, I don't know if I don't really have a vision on all the costs actually at the moment. I did, maybe Stephen can do that. And then also, Osama is saying, if I need the bottom indicator, that liquidity indicator as a filter, which package should I pick?
If you want with the what?
The liquidity indicator. So that would be the PitView Basic, I think, isn't it? The PitView Basic, they call it.
Mm-hmm.
I think the answer to that one is PitView Basic. And I don't know what the costs of the package actually is. Do you can you give a vision for that for the guys?
Yeah, it's $37 a month, and we offer yearly subscription that saves about 20%, and then a lifetime subscription that pays for itself, in 2 years.
Okay.
And then the next package is a PitView Advanced, which includes the tool for scalping. A lot of people don't need to scalp or want to scalp. So
that's the pair view. That's the pair view it includes then. Yeah.
Pair view, and then PitView Professional includes 3 instances of total view and 3 instances of pair view and 3 different trading tickets. You can take your trading tickets and point them all different, different pairs. They can be set up individually. They remember their individual settings, and so that's the package that we offer there.
Okay.
That's anywhere, it's $97 a month, and then and the lifetime subscription's ultimately $1,997. But
Okay.
they're all good values, and the higher the subscription level, we're also, we'll include things like PitView 201 and PitView 301.
Okay.
PitView
The
101
extra training
we'll make available to everyone, and then the other levels will be commensurate with, basically, I guess the best way to put it is the commitment that a subscriber makes to us will return in like kind with the commitment to them.
Yeah. Okay. Well, that's fair enough. That sounds good. Okay, then, Stephen. Well, I don't think there's any more questions. I apologize if I've missed anything in the chat box, but we've had I'm very, very impressed with the well, certainly the presentation and the questions, and the fact that we've still got quite a lot of people here 2 hours later. So that proves that obviously there was some attention being held and people are actually interested in the product. Again, I think the message is that there is a learning curve, but the explanation you've given certainly was very, very interesting for me, and I'm a user obviously of the product for 2 years now, believe it or not. But the simplicity with which you've actually just added that moving average, as I say, I'm slightly kicking myself that I didn't come up with that idea. But it's that obviously looks like it's very, very positive. I'm sure we will do another webinar in order to perhaps inform some of the other people who couldn't be here tonight and or explain other features of the more complex areas of the tool. And I'd just like to say thank you very, very much on behalf of Exact Trading and everybody who's turned up tonight. Thank you for turning up. The video will be recorded. I will post that out to everybody, and I think there is a host of information here. And again, just to maybe to review the video and have a look at the part, especially for that election where they were selling 2 or 3 days beforehand. And my take on that, Olivier, says brilliant webinar. Thank you very much. Thanks a lot.
Thank you for having me.
No, it's a pleasure. But I'm fascinated by markets. Obviously, you can obviously hear I get very excited about market. But it is fascinating when you think that these guys have actually obviously had the inside track on, almost certainly an inside track on what actually was going to happen there. So Mark says, awesome guys. Thank you very much. Great webinar from Asabib. Thank you. Thank you to both. Great stuff from Stuart. Thank you everybody for staying, and I hope this is going to help people to, as Stephen said, if you're marginally profitable, there's a lot of people that are sort of borderline profitable. This could be the extra little push that you need to some profitability. And I do agree with Stephen, actually, even though most people get attracted to the 1 minute and 5 minute, probably this type of 101 PitView things a little bit slower, which you can check when on your iPhone when you're at work, is probably the best type of thing to get going on. Michael says, thank you very much, Paul. Steve learned a lot. Thank you to both for great stuff from Stuart F as well. Okay, and Olivier says, green road to pips. Lovely. Okay, well, thank you, Stephen. I don't know actually quite where we are in terms of who's managing who in terms of taking the thing over, but I'll try and close everything off. I'll stop the recording. Thanks to everybody, and speak to everybody soon. And again, thank you all round to everybody for attending, and for Stephen for some very insightful presentation, and look forward to speaking to everybody very soon.
Thank you.
Thanks, and cheers. Have a great evening.
Bye-bye, everyone.
Bye-bye.
Great evening also.
Thank you.